Afternoon, students. Can you all hear me? Okay, afternoon, everyone. It's Mrs. Chetty, and this is the practical on Unit 2 on financial instruments. Okay, I hope you've all had a look at the practical question. We're going to go through the practical question together and discuss a few of the issues that arise, and then we will have a look at the solution. Okay. Okay, so the practical lesson is basically to do with a share buyback, a share consolidation, and it also tests earnings per share. So the following is the abridged statement of profit or loss and other comprehensive income of Chomp Limited for the reporting period ended 31 December 2019. So they give us the 2018 and 2019 profit before tax, and then income tax expense and profit for the period. Then they tell us that Chomp Limited has 1.8 million Class A ordinary shares in issue on the 1st of January 2018. These shares had been issued for R1 each. On the 30th of April 2018, 450,000 Class A shares were bought back by Chomp for R2 per share. So who can tell me this 450,000 share buyback, is this for value or not for value? Okay, correct. So the 450,000 Class A shares that were bought back by Chomp for R2 per share, this is a for value share transaction. Okay, it is for value because there's money exchanging hands. On the 1st of April 2019, the company had a share consolidation where every 10 ordinary shares were converted to 2 shares. So if we have a look at the transaction on the 1st of April 2019, where we have a share conversion, where we have a share consolidation and 10 shares were converted into 2 shares, is this a for value or for no value share transaction?
It's for no value.
Okay, it is for no value. Someone is saying you guys have done this question. I don't think you have. Okay, well, let's just carry on with this question. You guys are correct. It is for no value. Okay, hopefully you all did this question before you came to the session. Okay. So then if we carry on, we also have dividends. So we have Class A dividends of 1.1 million in 2019, and in 2018, they were 950,000. These were paid to Class A shareholders on the 31st of December 2019. Chomp Limited also had 50,000 non-cumulative, non-redeemable Class B preference shares in issue. So if these shares are non-cumulative and non-redeemable, would these preference shares be classified as a liability or as equity? Okay, well done, correct. Please can you mute your mics unless you have a question you want to ask? So because these preference shares are non-cumulative and non-redeemable, it means that these preference shares will be classified and recorded as equity. So a preference dividend of 100,000 in 2019 and 100,000 in 2018 was declared and paid for the year ended 31 December 2019. So there was no other comprehensive income for the 2 reporting periods. The retained earnings balance, they give that to us on the 31st of December 2017. Okay, so that is the information they've given to us. So now let's have a look at what they're actually wanting us to do. So step 1 is to prepare the journal entries to be posted in the books of Chomp Limited for the reporting period ended 31 December 2018. Then 1.2, they want us to prepare the journal entries to be posted for the reporting period ended 31 December 2019. So let's go to the first required and let's have a look at the journal entries that are going to be posted in the books of Chomp Limited for the reporting period ended 31 December 2018. Okay, so obviously when we look at the journal entries, we want to go back now to the information that was given to us. So they told us that we had a certain number of shares in issue on the 1st of January 2018. They told us these shares were issued for R1. Okay, then on the 30th of April, 450,000 Class A shares were bought back by Chomp for R2 per share. So now we need to ask ourselves, what are the journal entries to show the share buyback? So we will obviously have a debit and a credit. But the first thing I want to ask you, are these shares bought back at the same price at which they were issued? So these shares are being bought back by Chomp for R2 per share. They were issued for R1 per share. So do you guys agree that there is actually a premium here that Chomp is paying to buy back these shares? They are buying the shares for R2 where the shares were originally bought for R1. So in this transaction, we also have a premium that we need to take into account. So who can tell me what the journal entry is going to be for the share buyback? What are we going to debit and what are we going to credit? Let's start with the credit because that is obviously the easiest part of the journal entry. We are going to be, Chomp is going to be paying the shareholders R2 per share. So what are we going to credit here? We are going to credit bank, okay? The court is going to be paying out to its shareholders. So the bank account is going to be decreasing. And if the bank account is decreasing, then we are actually going to be crediting the bank account. Okay, so correct. You guys have said credit bank. And who can tell me what the amount is that we are going to credit bank with? Okay, good. We are going to credit bank with 900,000. And the way we calculated that 900,000 is we took the number of shares that we are going to be buying back, which is 450,000. And because Chomp is going to be paying R2 per share, we took the number of shares that Chomp is buying back, which is 450,000, and we're multiplying that by R2, and that will give us 900,000. Okay, so we've established that we're crediting bank. Now, what are we going to be debiting? Who can tell me what are we going to be debiting here? Okay, some people are saying we're going to be debiting share capital, and some people are saying we're going to be debiting retained earnings. Okay, and you are both correct. We are going to be debiting share capital with 450,000 being the shares that are being bought back. Okay, remember these shares were issued for R1 each. So we are going to be debiting our share capital account with 450,000, which represents the original value of the share issue. Then we also need to debit our retained earnings. So we need to debit our retained earnings to reflect that these shares are going to be bought back at a premium. So the premium that is paid by the company, that is going to come out of retained earnings. Okay, so we are debiting share capital and we are crediting retained earnings. Sorry, we're debiting share capital and debiting retained earnings. Okay, and then we are crediting bank. So that is the first journal entry. And then we carry on with the information given to us in the scenario where they give us the information of the dividends. So, okay, in 2018, what is the other journal entry we are going to process? We were told that dividends of 950,000 were paid to Class A shares in 2018 and 100,000 in preference dividends were paid in 2018. So what are our journal entries here for these dividends? Okay, we are going to be debiting our Class A dividend paid. How much did we pay to our Class A shareholders? We paid 950,000, okay? And in 2018, how much did we pay to our Class B preference shareholders? We paid 100,000. So we are going to be debiting our dividends paid, and then we are going to be crediting our bank account. Okay, so it says here specifically that these dividends were paid. So if they were paid, we know that the money is coming out of our bank account. Okay, so there isn't going to be a dividend receivable in this case. If they were declared and not paid, then obviously we wouldn't be able to show it coming out of bank. Then it would be then we would owe our shareholders the money. Okay. So those are the journal entries for 2018. Now let's have a look at the journal entries for 2019. So remember, on the 1st of January 2019, the company had a share consolidation where every 10 ordinary shares were converted to 2 shares. So what is the journal entry going to be here? Is there going to be a journal entry? Okay, is there going to be a journal entry to show the share consolidation? Okay, you are correct. There's not going to be a journal entry. If you think about the share consolidation, what is the company actually doing? They are merely converting the number of shares in issue. So for everyone who holds 10 ordinary shares, these are going to be converted to shares. So in actual fact, there is no journal entry. It is merely the number of shares in issue is going to change. Okay, so well done. There's no journal entry for that transaction. But then remember, a dividend was also paid in 2019. So just like you had the journal entry for the dividends in 2018, we are going to have a similar journal entry in 2019. So we're going to have our dividends owing to our Class A shareholders, and we're going to have our dividends owing to our preference shareholders. So for 2019, the dividends that were declared and paid were 1.1 million. And in 2019, the preference dividends declared and paid was 100,000 Rand. Okay, and because they were declared and paid, it needs to come out of our bank account. So we're going to be debiting the dividends accounts for Class A and Class B shareholders, and then we're going to be crediting bank to show that the dividend was declared and paid by Chomp. Okay, so those look like the only journal entries for 2018 and 2019. So the next thing we need to do is we need to calculate the earnings per share. Okay, so who can remember when we calculate the earnings per share, how do we do this? So how do we calculate the earnings per share? Correct. So we calculate the earnings per share by taking the basic earnings divided by the weighted average number of shares. Now let me ask you, are we calculating the basic earnings attributable to all shareholders, or is it only ordinary shareholders? So the basic earnings, is it for ordinary shareholders only, or is it for all shareholders? Okay, correct. So the earnings per share is basically showing the earnings per share attributable to ordinary shareholders. So when we calculate our basic and our weighted average number of shares, we need to keep in mind that we are only looking at ordinary shares. We are not looking at the number of preference shares, okay? So for this question, I'm going to share the solution because it does get a bit complicated. And it's just easier if I share the solution so that we can go through it together. Okay, I have an Excel document, so I'm just going to see if I can share this. Okay. It doesn't look like I can share the Excel document. Let me just try one more time. Sorry, guys. You can have a look at that required and see if you can calculate the earnings per share while I just Okay, is someone raising their hand? Do you want to ask a question? Okay, let's just see if I can zoom in. Okay, can you guys see this? So this is the solution. So this is where we had the journal entries. So we've gone through the journal entries. Now we just need to have a look at the earnings per share calculation. Okay, and I just thought because this is a bit of a complicated calculation, it's best if we go through it together. So remember we said that the earnings per share is calculated by taking our basic earnings and dividing that by the weighted average number of shares. And we said that both of these are attributable to ordinary shareholders. Okay. So in front of you, we need to calculate our basic earnings for 2018 and 2019. Okay, let me just see if I can zoom in a bit more. Okay, we'll just look at the calculations over here for basic earnings. Can you guys see that? Okay, I think that's as much as I'm gonna go. Okay, if you still can't see it, then try zoom in on your device. We're looking here at step 2.1. So the starting point for our basic earnings is to take our profit for the period. So these numbers for 2018 and 2019, these are actually given to us. These are the profit for the period, okay? But now we need to see, is there anything in this profit for the period that needs to be stripped out? So remember we said that we are trying to calculate the earnings attributable to ordinary shareholders. But remember, we have preference shareholders over here. So because we have preference shareholders, and these preference shareholders received a preference dividend of 100,000 in 2018 and 100,000 preference dividend in 2019, we need to strip this out of our profit for the period, because remember, we are looking for earnings attributable to ordinary shareholders. So because our preference shareholders have preference, they are paid before our ordinary shareholders. We cannot keep that preference dividend amount in there. We need to take it out, okay? So we are simply taking out the preference dividend that was paid to our preference shareholders, okay, to show that a portion of the profit for the period actually will be going to our preference shareholders because they have preference over our ordinary shareholders. And remember, our earnings per share calculation, we are trying to calculate the earnings per share that is attributable to our ordinary shareholders. So we are simply taking profit for the period which was given to us, and we are stripping out our preference dividend, which is 100,000 for both 2018 and 2019. So once we have taken out the preference dividend that is attributable to our preference shareholders, that is going to give us earnings that is attributable to ordinary shareholders. Okay, are you guys all happy with that? Let's just check the chat box. Okay, I have zoomed in. Hopefully you guys can see. So that is our earnings attributable to our ordinary shareholders. Now that we have that, we need to calculate what is our WANOS. So remember, our WANOS is our weighted average number of shares. And this is the weighted average number of ordinary shares, okay? So now this is where things might get a bit complicated. So when I went through the scenario, you identified that there was a transaction that was for value and there was a transaction that was for no value. And these are treated slightly differently when we calculate our weighted average number of shares. But before we have a look at our weighted average number of shares, remember this weighted average number of shares, we are calculating this to calculate our earnings per share. So the 2019 and 2018 column, this is there to calculate our earnings per share. But let's first have a look at the actual number of shares, okay? So the actual number of shares, they told us that in the scenario, we had 1.8 million Class A ordinary shares, okay? That was on the 1st of January 2018. Then the company had a share buyback where 450,000 Class A shares were bought back, okay? So if we have shares that are bought back from the shareholders, we know that once those shares are bought back, we are basically reducing the number of shares in issue. So the actual number of shares that we bought back was 450,000, okay? We're calculating the actual column here. We're going to look at the earnings per share calculation separately just now. So we had an opening balance of 1.8 million and the company bought back 450,000 Class A shares. At the end of 2018, this left us with 1.350 shares in issue, okay? Then at the end of 2018, that leaves us with 1,350,000 actual shares. Okay, so this is the actual number of shares. Then obviously for 2019, our starting point needs to be the actual number of shares in issue. Okay. So now we have calculated the actual number of shares for 2018. Let's have a look at our weighted average number of shares for 2019. So on the 1st of January, the opening balance of our shares is going to be 1,350,000 shares. Okay, we'll do 2018 just now. So in 2018, there was a share buyback. That does not influence 2019 here. Okay, then in 2019, we had a share consolidation where there were 10 ordinary shares and these were converted to 2 shares. Okay, so just before the share consolidation, we had 1,350,000 shares. How many shares did we have after the share consolidation in 2019? Okay, guys, I'm going to go through 2018 just now. I've just decided to start with 2019 because we calculated the actual number of shares. Okay, so let's have a look at 2018. We're going to go to 2000. We're looking at 2019 column. We're going to do 2018 just now. Okay, so let's have a look at 2019. So we had an opening balance of 1,350,000 shares before the share consolidation. Now they told us that the share consolidation happened, and for every 10 ordinary shares held, these were converted into 2. So if we take the 1,350,000 and we divide that by 10 shares and multiply that by 2, we'll see that after the share consolidation, we are going to have 270,000 shares in issue. So as a result of the share consolidation, we are actually reducing our number of shares by 1,080,000. Okay. Now, when we look at the 2018 year, so we're going to look at the 2018 column now. Remember, when we had the share consolidation, we said it was an issue for no value. Okay, so do you agree when we have a for no value issue, we are not going to weight this? Okay, so in the 2019 year, we are not going to weight it because there was no increase in the earnings potential because it was for no value. So there, we are not going to weight it even though it happened on the 1st of April 2019. However, in order to be comparative, we are going to adjust our comparative column when we are calculating our earnings per share. So we need to adjust our comparative column for 2018. Okay, so let's have a look at the 2018 column in totality from the beginning. So at the beginning of 2018, they told us that the company had 1,800,000 Class A shares in issue. So this was the opening balance in 2018. Then they told us on the 30th of April 2018, 450,000 Class A shares were bought back by Chomp for R2 per share. So remember, we are calculating the weighted average number of shares in issue here, okay? And remember, at the beginning of the lecture, I asked you, was the share buyback for value or for no value? And you said it was for value. So remember, when we have a for value transaction here, our earnings potential is going to change. So we need to weight this to show how many months our earnings potential has changed for 2018. So how do we do this? We take the number of shares that were bought back, which is 450,000, and we ask ourselves, when did this transaction happen in the year? So it happened at the end of April. So we are going to count how many months of this transaction did our earnings potential change. Okay, so we're going to count May, June, July, August, September, October, November, December. So if you count on your hands, you'll see that was for 8 months. So after the share buyback happened, there were 8 months still left of the year. So we're going to take the number of shares that we bought back, which was 450,000, and we're going to multiply that by 8 months because that is how many months are left in the financial year, and we're going to divide that by 12. Okay, so the share buyback resulted in a weighted average number of shares of 300,000. And we got that by taking the 450,000 shares that were bought back, and we weighted it based on the number of months left in the year. Okay, now if you compare the actual column for 2018, the actual number of shares bought back was 450,000. But because we had to weight this to show the change in earnings potential, we are only showing the weighted number of shares, which was 300,000 shares bought back. Okay. And then if we calculate the balance after the share buyback, we had 1.5 million shares. Now remember in 2019, where we had the share consolidation, we said that was for no value. And when you have a for no value share transaction, in order to be comparable and be able to compare the prior year to the current year, we need to adjust our prior period as well to show the share consolidation that happened. And this is only when you calculate your earnings per share, okay? So just before the share consolidation happened, obviously the share consolidation happened in 2019, but we are just adjusting the 2018 comparative so that when the users look at our financial statements, they will not get confused, okay? So in order to calculate the weighted average number of shares as a result of the share consolidation, we are going to ask ourselves, well, how many shares were in issue just before the share consolidation? And in 2018, there were 1.5 million shares in issue. And then we need to multiply this by 2 and divide it by 10, because for every 10 shares that were held, these were converted to 2 shares. So if we take 1.5 million and we ask ourselves, well, how many shares will we have in our comparative period after the share consolidation? You will have 300,000, okay? And then if you take this balance, 1.5 million minus 300,000, that will give you the amount of your share consolidation in your comparative, which is 1.2 million. Okay, so this seems confusing, but once you go through it systematically, it does hopefully make sense to you. So just please distinguish between your actual number of shares, and then the other two columns here show the weighted, okay? It's weighted number of shares. You are simply doing these two columns to calculate your earnings per share. So we calculated our earnings attributable to our ordinary shareholders, and we have calculated our weighted average number of shares. So now we can calculate our earnings per share. So our earnings per share in 2018, once we take our earnings attributable to our ordinary shareholders of 1.764, and we divide that by the weighted average number of shares, which is 300,000, we are going to get an earnings per share of 5.88 rand if you're expressing it in rands. Then for 2019, we do the same. We calculated our earnings attributable to our ordinary shareholders being 2.312,500. That is our basic earnings. Now we are dividing that by our weighted average number of shares, which is 270,000. So if we take our basic earnings and we divide that by our WANOS, that is going to give us an earnings per share of 8.56 rand. Okay, so that is how you calculate your earnings per share. The end part is not difficult. What's the difficult part is probably calculating your WANOS, because it can be a bit confusing if you don't do it systematically. My advice would be to always ask yourself, are you looking at a for value or for no value share transaction? Because they are treated differently. Okay, when you have a for no value transaction, like when we had the share consolidation, remember you will have to adjust your prior period in order for the prior period to be comparable when you do your earnings per share calculation. Okay. Also, when you have a no value transaction, it doesn't matter when the transaction happened during the year, there will be no weighting because it is no value, for no value. And then if you compare that to the share buyback, so the share buyback was for value. And when we had the for value share buyback, we had to weight it because our earnings potential changed. Okay, so hopefully that makes sense. That is your earnings per share calculation. Now, if we have a look at the last step here, so we had a look at the first step, which was our journal entries. Then we had a look at step 2, which was to calculate the earnings per share. Then the last step is to look at the presentation of financial statements. They tell us to present the statement of changes in equity of Chomp Limited for the reporting period ended 31 December 2019, and they say comparatives are required. So let's have a look at the statement of changes in equity. Okay. So if we have a look at the statement of changes in equity, we are asked to do comparatives. So we'll start with the 1st of January 2018. So remember, they told us our opening balances. The opening balances were given to us. So the share capital opening balance was 1.8 million, and the retained earnings opening balance they gave to us at the end of 2017, which becomes the opening balance. That is 2,350,000. So remember when we did our journal entries, we had the share buyback and we debited our share capital account and we debited our retained earnings account. So this simply shows those journal entries. So because the shares were originally issued R1 each, our share capital account is being reduced by 450,000, which represents the 450,000 shares at R1 each. Okay, so because it's a share buyback, we are reducing the number of shares that are in issue for Chomp. Then we also debited our retained earnings account. Remember these shares were bought back at a premium. They were issued for R1, but they were bought back for R2 per share. So the premium is R1 per share. So in order to calculate and pay our shareholders, we are paying them R1 premium, and that is going to come out of the retained earnings account. Okay, so this 450,000 represents the share premium that was paid when the share buyback took place. Then the total comprehensive income for 2018 was given to us at the beginning of the question. So we are simply going to include our total comprehensive income into our retained earnings for 2018. Then remember, we also had our dividends. Okay, so we had Class A dividends declared in 2018 to our Class A shareholders of 950,000. Then we had our Class B dividends declared, which is our preference dividends of 100,000. Remember when I asked you if these preference shares were equity or a liability, and all of you said it was an equity because it is non-redeemable. Therefore, because the preference shares are equity, our preference dividend will be shown here in our retained earnings. Okay. Then this is just our total over here at the end of December 2018. Then for disclosure purposes, we need to show our dividend per Class A share and our dividend per Class B share. So this is simply calculated by taking the dividend for the year for your Class A shares and then dividing it by the actual number of shares. So remember when we did our earnings per share calculation, we calculated our weighted average number of shares. But here, when you do your dividend per share calculation, you are not weighting the number of shares. Okay, so what I'm going to do, I'm going to upload the Excel document which shows how we got these numbers. But if you have a look at your dividend per Class A share, this is calculated by taking the dividend for the year, which was 950,000, and dividing that by the actual number of shares in issue for 2018, which was the 1,350,000. Okay, and that will give you 0.70. So for our dividend per share calculation, we are using the actual number of shares in issue at the end of the year. We're not looking at our weighted average number of shares. We only do the weighting when we calculate our earnings per share. So for the dividend per Class A shares in 2018, we calculated by taking the 950. Okay, I don't know if it's going to write here. So it's 950, and then we divide that. Will it work? Okay, it's a bit big. 950,000, that was the dividend, and we divided by the actual number of shares, which was 1350. Okay, that was for the dividend per Class A share. Then if we have a look at the dividend per Class B share, how do we calculate it? It is basically dividend to the preference shareholders, which was 100,000, and then the number of preference shares in issue were 50,000. So if you take 100,000 being the dividend to our preference shareholders divided by the number of non-redeemable preference shares, that will give us 2 Rand over here. Okay, does that make sense? Then if we have a look at the 2019 year, so remember our closing balances for 2018, these will become our opening balances for 2019. Then we had our total comprehensive income for 2019, which was given to us at 2,412,500. That is simply our total comprehensive income, which we need to add to our retained earnings. Now remember, in 2019, we had the share consolidation where 10 ordinary shares were converted to 2 ordinary shares. And when we were doing the journal entries, you guys said that there was no journal entry, there was no change in share capital or retained earnings as a result of the share consolidation. So if you look here in our statement of changes in equity, you will see that the share consolidation, it doesn't affect share capital, which is the Rand amount. It doesn't affect the retained earnings. It is simply just the number of shares are changing. So once we have added in our total comprehensive income, now again, we need to take into account the dividends that were declared. For 2019, there was 1.1 million dividends declared and paid to our Class A shareholders. So that will be reducing retained earnings. Then we have our Class B preference shareholders, which were paid 100,000 Rand dividends. Okay. So then once we have included all of our dividends paid and our total comprehensive income, we will have our closing balance over here. And when we have a look at the dividend per Class A share, we simply calculate the dividend per Class A share by taking the total dividend. So for 2000, sorry, over here where it's 4.70 Rand, we will take the 1.1 million and we will divide it by the actual number of shares being 270,000. Okay, so it seems confusing. This 270,000 comes from here. This is the actual number of shares, okay? Even though this was the for no value, it represents the actual number of shares. And then for our dividend per Class B for Class B shares, we simply take the preference dividend, which was 100,000, and we divide it by the number of shares in issue, being 50,000. Okay. So someone has asked me to explain the weighted average number of shares. I'll go through that again at the end. I just want to finish this question. 3.2. Let's just see what it says. Disclose a share capital note in the financial statements of the company for the reporting period ended 31 December 2019. So we've looked at the statement of changes in equity. Now we just need to have a look at the share capital note. Okay, and this is for 2019. Let's just see if I can add it. So this is 2019, and that there is 2018. Okay. So when we look at our share capital note here, we are interested in the number of shares. So ordinary shares of no par value, okay, but we're concentrating on the issued shares. Wait now. So we're looking at the number of issued shares. Okay, I don't know what is going on here. So we have the issue number of shares at the beginning of the year. So in 2018, we were told that we had 1.8 million shares in issue at the beginning of the year. Then we bought back, we had the share buyback, and the actual number of shares bought back was 450,000. And that gave us a closing balance of 1,350,000 shares. So remember here we are not concerned with the weighted average number of shares. Here we are looking at the actual number of shares. So we only calculate the weighted average number of shares when we're looking at our earnings per share. But here we are actually concerned with the actual number of shares. So you remember when we did the weighted average number of share calculation, this was 300,000 because we weighted it for 8 months of the year. But here, when we are looking at our note disclosure, we are actually looking at the actual number of shares. We are not weighting it. We only weighted it because we were looking at our earnings per share calculation. So if we look at 2019, at the beginning of the year, we actually had 1,350,000 shares in issue. And then we had a share consolidation, which resulted in us reducing the number of shares by 1,080,000. And that gave us shares in issue at the end of the year of 270,000. Okay, so that is the loss required. I'll go through the weighted average number of shares calculation because I think that's where a lot of you would get stuck. Okay. So I'm assuming you're happy with how to calculate the earnings attributable to ordinary shareholders, okay? We are simply taking our profit for the period and we are subtracting the preference dividends because the preference shareholders have preference. They will get paid before the ordinary shareholders. So this will give us, once we have stripped out the preference dividends, this will give us the earnings attributable to ordinary shareholders. But let's have a look at the weighted average number of shares. So remember I told you to distinguish between the actual number of shares and the weighted average number of shares. So let's have a look at our actual number of shares for 2018, okay, only. So for 2018, they told us that the number of shares in issue at the beginning of 2018 was 1.8 million. Then remember we had a share buyback where we actually bought back 450,000 shares. And then at the end of 2018, we actually had 1,350,000 shares in issue. So that is the actual number of shares. We are only doing this to show you that the weighted average number of shares is not the same as the actual number of shares. So let's have a look at the 2018 year. Again, we start with the opening balance that they gave us of 1.8 million. Then in 2018, we also need to take into account that there was a share buyback. But because we are calculating the weighted average number of shares, we are not going to put the actual number of shares of 450,000 because we need to show that it was weighted, okay? So we are going to take the 450,000 and we are going to weight that to show that that share buyback took place within 8 months of the year. So if we go 450,000 shares and we multiply that by 8/12 to show that that share buyback happened and there were 8 months left, we get 300,000. So remember, this was a for value share transaction, which means we need to weight it because our earnings potential changes after the share buyback. Okay, the company has less share capital, which means it likely will earn less earnings. Okay, so then we total that. Okay, so essentially at the end of 2018, we have 1.5 million. Then the complicated thing happens that in 2019, there was a share consolidation, okay? Remember, when the share consolidation is a for no value, when we have a for no value, we need to adjust the comparative. So this 1.2 million represents the adjustment to the comparative. It actually happened in 2019, but in order for the earnings per share calculation to be comparative, we need to adjust this as well. So just before the share consolidation, we had 1.5 million shares in issue. But now, in order to be comparative, we are going to pretend there was a share consolidation at the end of 2018. So they told us that the share consolidation happened and every 10 shares held were converted into 2. So we're going to take 1.5 million and we're going to divide it by 10 and we're going to multiply it by 2. So if we do that, we will be left with 300,000 shares at the end of the period. So then if we compare the opening balance just before the share consolidation to the closing balance after the share consolidation, you will see that the share consolidation resulted in a reduction of 1.2 million. Okay, remember the share consolidation actually happened in 2019 here, but in order for the earnings per share calculation to be comparable, we need to adjust for it in the 2018 year as well. Okay, that is the 2018 weighted average number of shares over here. This is different to the actual number of shares for 2018. Okay, then in 2019, we're going to start with our actual number of shares at the end of 2018. Okay, look here, this comes from this calculation over here. The share buyback happened in 2018. Then we have the share consolidation, which actually happened in 2019. So the share consolidation took 10 ordinary shares and converted it into 2. We said this was for no value. Okay, so we're going to take our balance just before the share consolidation, which was 1.35 million, and we're going to divide that by 10 and multiply that by 2 because that allows us to get the number of shares after the share consolidation. So if we take 1,350 divided by 10 times by 2, because we are swapping every 10 shares into 2 shares, that will give you a total weighted average number of shares of 270,000, okay? And then if you compare these two balances, you will see that the share consolidation resulted in a reduction of 1,080,000 in the number of shares. Okay, so that is the weighted average number of shares for 2019 and 2018. And then the column in red is the actual number of shares. Okay, you mustn't confuse them because then you won't get the correct earnings per share. So someone asked, how did we get the 0.7 and 2 Rand dividend per share? And then I see that you guys have answered that. Well done. So that is the dividend per share calculation. And as the answer shows here, that the number of shares we are using in the dividend per share calculation is not weighted. Okay, we only weight the number of shares in the earnings per share calculation, not the dividend per share. So someone is asking, on the actual column, we didn't subtract the share consolidation, okay? Well, look at the actual column. The actual column was for 2018. The share consolidation happened in 2019, okay? So that's why they didn't subtract the share consolidation, because this actual column is for 2018 only. So that 50,000, Sombo, that is the number of preference shares. So we are taking the dividend per share, which is 100,000 preference dividend, and we're dividing it by the number of preference shares. So that 50,000 was given to you. It's in the third paragraph in the question. Okay. Do you guys have any other questions you want to ask? I'm going to put, I've got a very nice Excel document which shows all of these. And if you click on the Excel cell, it actually shows you where the numbers come from. So I'm going to put on the Excel document, and then this will assist you when you are looking at this question again. Okay, it doesn't look like there's any more questions. So I'm going to stop the